Do you think we'll end up re-globalizing?
I don't think it's possible to deglobalize, and I'll tell you why. There's certain product categories, once they become commodities, are better manufactured in low-cost countries.
Yeah.
And you know, the idea that you shouldn't manufacture socks in Vietnam because of some protectionism, or the fact that you'd rather pay 5 times more for socks, that makes no sense whatsoever. Yet, if you're building a new chip that actually can fuel AI, artificial intelligence, yeah, I can see. I'd rather do that domestically and keep that away from our economic competitors like China, who don't want to play in a level playing field unless they're willing to cooperate. And that's the leverage we have over them. So, you know, different product categories. And I would argue energy, we should remain self-sufficient. That was a mistake the administration made. You know, prior to the election, the country was completely independent in terms of energy production and oil and gas. And obviously, pipelines were shut down, policy changed. And I think that this current administration realizes they went too fast, too soon, and now we have to pedal back. I'm not trying to play politics, but it'll be reflected in the midterms in just a couple of weeks. And I think what we'll have after that would be very welcome by investors. It would be total gridlock in Washington. That is a wonderful thing. The pause that refreshes, no more bills, no more spending. Let's take a break for a while and then do jump ball in the election, you know, 24 months later. And I think that's a really good outcome, why many people like me are optimistic.
That's interesting. Yeah, of course, you're referring to the shutting down of the Keystone Pipeline by the Biden administration on day one of him taking office. And what I think is fascinating is this idea that you just said it, gridlock is wonderful. So this is really because when nothing gets done, markets can just take into account the earnings that we're expecting and not have to worry about intervention. And that brings up, though, this idea of the Inflation Reduction Act, which, according to Wharton, doesn't actually reduce inflation, but has some benefits for the EV sector. What's your take on the Inflation Reduction Act? Would you be increasing your allocation to some of these energy plays that could potentially stand to benefit from that?
I think that act is very inflationary. I think the idea of forgiving student debt is very inflationary and incredibly unfair to generations who were burdened with that debt, or in fact couldn't even go to college because they couldn't take on that debt. I have never seen an act more un-American than forgiving student debt. And I hope that that gets stuck in litigation and gets reversed. It's outrageous what's going on there. And that's extremely inflationary. And that has nothing to do with politics. That's just bad policy. You know, doing nothing is always an option. That never happens in government until there's total gridlock, which we're going to get. Assuming the House flips, nobody knows what the Senate's going to do yet. It's jump ball. But bottom line is, gridlock is a great thing. It's a good thing. Politicians can't get any bills done and nothing happens, which is a great option, because it's a form of certainty in the market. And we've had so much printing of money, so many bills, so much bad policy, regardless of what side of the aisle you're on. And I just detailed my own personal opinion about student debt, which I think is just, the more I think about it, the more my blood boils. It's just so unfair. But at the end of the day, all that stuff gets shut down. And that is what I'm looking forward to and very encouraged by.
Now, some people might respond to you just on that note and say, hey, well, isn't it unfair what outrageous tuitions are being charged for college? And then folks might not be able to get a job that actually pays them enough to pay off their student debt. What would you say to somebody who says that?
It's a fair comment. Let's work on that problem. But let's not forgive one cohort's debt when generations past never got that opportunity. This idea of free money for just the select is absolutely un-American. That is not what built this democracy. It's just outrageous. And the idea that you just pick one cohort, they're the special ones that don't have to pay for their debt. I agree with you. Education costs are too high. Let's work on that problem. Let's figure out a new way to approach that. Let's use technology to maybe make it a more level playing field, but not giving one cohort, just one, the special ones, they get their debt forgiven. Outrageous.
Well, hey, if you wanted another stimulus check, you could always move to California, where Governor Gavin Newsom is now providing inflation relief checks. What's your take on Governor Gavin Newsom providing these to people earning up to $500,000 a year?
Well, you know, there are some ideas that are bad ideas, and there's some ideas that are stupid ideas. Very rarely can you combine both, but that's what you've got here. A really bad and stupid idea, because you're just fueling inflation. Now, the great news about what's going on between state to state is we're finally getting a competition.
Yeah.
Idiot management states are losing taxpayers, losing capital from companies, and lots of movement out of them. California, New York, New Jersey, Massachusetts, people are leaving there and companies are leaving there and moving to places like Colorado, North Dakota, Florida, Montana. I am doing my fair part of that too. I'm moving companies out of California. That place is great to visit, but not fit for business. I would never invest a dime there. Same with New York. I've moved a big project out of New York to Norway, a data center there because New York policy is unstable. And I spend a fair amount of my time on the Hill showing these examples to lawmakers on both sides of the aisle. I'm just one investor, but we make aggregate decisions, millions of them by the day, and those places are uncompetitive. Elizabeth Warren's Massachusetts is not a place for business. And that's why they keep trying to overtax and overtax. They're past 50%. California's past 50%. New York City's past 50%. No problem. People are fungible. They move. They're not stupid.
Yeah.
Why would you go sit in a cubicle in a New York high-rise when you can be in great weather in Miami and save a ton of money on taxes? Exactly what everybody's doing.
Well, on that note, I'm curious on your thoughts on sort of scaling single-family real estate investment. That's something that I've launched a startup on. We've raised over $25 million. It's House Hack is the name of it. And we're looking to buy single-family homes and potentially multifamily, and then rent them out with a combination of short and long-term rentals. So we have a nice mix of sort of cash flow in various different markets. So South Florida, Texas, and maybe even I know you might not like it, but even some California to diversify the portfolio. What's your take on? Would you follow the jobs? Would you follow where the new offices are being built, like in Miami and Brickell? You've got, not that people like them on social media, but Citadel investing over $1 billion in Miami.
Yeah, I've been quite an investor in the Miami market now for 6 years in terms of my allocation of real estate investments. I would say one thing about real estate that's unique as a sector. Now, normally portfolio theory would say this: no more than 20% in any one sector, no more than 5% in any one position. That has been a standard in the indexing market for sovereign wealth and pension plans for 100 years. And I abide by those rules in most of the mandates that I'm involved in managing, with the exception of real estate. In our operating company, our holdings in real estate now are at 39%, which
Wow.
is significantly, it's a heavy overweighting. And the majority of that is in Florida, where we are very positive and constructive about the demographics that are occurring there. Now, I've heard all the arguments about Miami sinking underwater, and I get all that. We've been talking about that for 100 years, and there is always that risk in any coastal investment. But when you look at the demographics and demand for properties and office properties in South Beach or Miami proper or Brickell or even Palm Beach or other West Palm Beach and other areas where I am an investor, we see this continuing and on an ongoing basis. And I have to thank the politicians in New York and Massachusetts and California for this wonderful investment opportunity, because this is why prices there have not corrected and why they continue to be very, very buoyant and demand remains strong. The harder you make it to start a business in New York, the better it is for me in Miami. And so, that's the bottom line. And I talk to Mayor Suarez every day and all the other politicians there. They are very open to business. They understand the advantage they have. They're running around the world with their arms open. And on top of all that, we've got the crypto community, which some people think is going to be the 12th sector of the economy in a decade. And I agree with that theory. Centered, one of the global centers now is Miami. So I spend about 5-6 months a year there just dealing in that sector.
So you have roughly twice your typical sector allocation now allocated to real estate. You said 39%. Obviously, mortgage rates have increased from 2.5% in December to now on average over 7%, which is remarkable and potentially indicates that buyer purchasing power should go down by about 45%. Not necessarily to say that real estate prices would fall by that, but it does look like there is an inflection point. Housing prices have started to fall since about March to May. What's your take on how deep this correction can go? You've got, some folks screaming, we've got a 50% coming. And then the counter argument is this is no 2008. Lending standards are too strong. Maybe we're in for a, average 15% correction. Where do you stand?
We haven't seen a 15% correction in any markets yet. There's fundamental demand, obviously, and the consumer remains buoyant. But you're right, we could have that. Traditionally, the real estate cycle used to be 7 years. That has gone, we haven't had a significant correction. I don't care what market in North America you look at, for 25 years. And that's because of change in demographic and demand for housing, both rental and assumed ownership. But you gotta look at it this way. Real estate cycles are really interest rate sensitive, as you detailed. But these mortgage rates right now are still traditionally very low if you go over a 40, 50-year period. I've been an investor in real estate when interest rates are 15%, 1.5. I've been an investor when mortgage rates were under 4. And so at the end of the day, fundamental shelter and housing and office space and demand, industrial demand for real estate remains a constant in any economy at different levels of trajectory. But as an asset class, it has proven to be buoyant for hundreds of years. You know, the old adage, they stopped making it a long time ago. Particularly that applies to beachfront properties and vacation properties. And look what's happened in Montana. Look what's happened in North Dakota. Look what's happened to farmland. These are all investments that I look at every day. You know, each of them have their own merits or risks. There's no question about it. But at the end of the day, it's a fundamental building block in anybody's portfolio. And the only decision you have to make when you're young is how much debt do I want to take on? And that's governed by the percentage of that mortgage. And so you're right. If mortgage rates go past 7%, and I think the terminal rate on the Fed will be under 5, so you could see some high-risk mortgages at 7. That's still traditionally not a very high mortgage rate.
Now, some would argue that, look, last time we had 15% mortgage rates, the median home price was maybe $80,000 to $120,000. Now we're sitting at $400,000, around 4 times that. Do you think that we could be more sensitive because of these higher prices? And then also sort of a part two to that, you mentioned we haven't seen a significant correction in 25 years. What about '08?
That's true, but it was a very, very short period, 18 months. And so when you think about an asset class like real estate, it is a very slow turn asset class. The entry and exit fees are very high. You don't flip it, you don't trade it. You really have to think about the cap rate is reflecting. And what I would agree with your statement in '08 with the financial crisis was cap rates went up. And so that's the inverse. So if you buy a building at 4.5% cap rate, which was AAA office towers in Boston in '08, yeah, they spiked up a bit for that 18 months, but there were very few trades in that market. So, you know, these assets, people think very long-term on. Now, I would agree there's a new reason to consider cap rates going up in industrial and commercial real estate. That's because of the new trend in work environments, which are not so focused on office anymore. For most companies now, they have flexibility, and up to a third or half of their employees never come back to the office. And that's probably permanent, particularly in sectors like technology. So that may put some pressure on cap rates for commercial, which means their values go down. If cap rates go up, the building's worth less. However, in the case of residential, the inverse is true, because all of a sudden you've got rural communities like Champaign-Urbana and places where people want to live, raise their kids, go to good schools, get more house for the dollar. Those cap rates, or the cost of those houses, have gone up, and the cap rates have gone down, because all of a sudden you don't have to live in Chicago. You can live in Champaign-Urbana, and the lifestyle there on Greencroft Avenue, right on the golf course where I used to live a long time ago, that's a beautiful place to raise a family. And you can still participate in the Chicago community.
Wow. That's a very good point. So some real demographic changes there. So what advice would you have for scaling sort of a single family portfolio? Would you be following the jobs? Would you avoid any particular, would you avoid short-term rentals? What's your take on that?
No, I do a blend. I like your idea of a blended portfolio. I like a real diversification of duration. When you do rental deals, you want diversification just in case rents go up, then you have the ability to reset them at a higher rate if they're shorter term. But that's all part of the portfolio analysis. I do, however, prefer putting in my investments into business-friendly states where you've got the constant demand of entrepreneurs starting businesses, which will bring you more and more customers. I mean, customer acquisition is what you care about in a real estate portfolio. So I prefer places like Florida, like Texas, like Montana, like North Dakota, any state that is pro-business, that is not raising its taxes past 50%, because that is just the breaking point. Remember, when you pay 52% tax, that's the money you can't pay for your rent, because you're giving it to a poorly managed government who goes and wastes it up for you. That's what's happening in Massachusetts. That's what's happening in New York. There's a reason these places are uncompetitive. Look at San Francisco. Walk around downtown. That is a war zone. Los Angeles, a war zone. It's a complete collapse in society, because what they've done is they've broken management. They have no way of managing those anymore. They've squandered their resources. They've squandered their money. California is a disaster. Great place to visit. Wonderful to take that drive down the highway, but I wouldn't touch it as an investment. And at night, my goodness, I wouldn't wear any of my watches out. That place is, I wouldn't even walk in San Francisco at night. It is literally a war zone. You wouldn't recognize it anymore.
I got so lucky, you know, I almost bought in February of 2020. I almost bought one of those painted ladies that you saw in the intro of Full House, those row houses, a complete fixer-upper. And I would have been locked down forever and not been able to do anything on that project because COVID hit right after. Turns out that seller, who beat me by $5,000, like $3.5 million, tried reselling it. Permits approved 2 years and $500,000 later just for paperwork. Tried selling it for what she paid for it after having spent $500,000 and had to delist it after 6 months because nobody would buy it.
No, I agree. I mean, you think about that. That market has suffered because of policy, bad decisions by government, bad overall policy, and then, of course, the collapse of society. Nobody wants to invest in a war zone. And I would argue Los Angeles and San Francisco, they are modern day war zones.
Wow. Now, you mentioned in this last touch here on real estate that the terminal rate from the Federal Reserve, you believe, will be under 5%. Some folks have actually been calling for this to potentially go up to 6% because they don't believe that the Fed's actually going to get inflation down. On one hand, you've mentioned earlier, Jeremy Siegel, who was really opposed to all of the money printing that we're doing and now is saying the Fed is overdoing it. But then you also have others who say, I don't know, this is going to take a lot longer. And so far, the idea that it's going to take longer to get inflation down has been true. What do you say to people who say, no, I'm waiting to buy my treasuries until that Fed funds rate is at 6%. It ain't pausing anytime soon.
Yeah. What I say is the lesson that every investor learns over a lifetime of investing, it is 100% impossible to time the market. 100% impossible. Everybody's tried it. Everybody's had their fingers burned. And I'll give you an example over the last 3 weeks. And so if you looked at 2020, which was an extremely volatile year as we started to understand what COVID was doing to the economy and the global economy, the entire returns of that year, which was actually a good year for equities, happened in 19 trading sessions. 90% of the returns happened in 19 trading sessions. That's 8 hours times 19. Wow. And if you were not in the market that day when it went up 1,200 points or 800 points or 1,500 points or whatever happened in the volatility, you had no returns whatsoever. The problem is which day. And I remember in March, April, May of 2020, when I was in Miami in lockdown and working with my team on our portfolios, our global operating company portfolios, watching us lose millions of dollars by the minute one day, and then the next day watching this reverse of it. Just an incredible amount of volatility. And having seen that movie before, I was able to tolerate it by drinking great Chardonnay and watching the sharks eat the pelicans outside of my balcony, because for the first time in 500 years, no people were allowed on the beach. And the great whites came right to the shore to eat the pelicans. It's never happened before. And that told me we're in a different time here. There's never been a time when not a single person was on Miami Beach. It was the most extraordinary scene I've ever looked at. And it happened week after week. And that gave me solitude. I said to myself, okay, I'm here watching the sharks. They're doing what they know how to do and have for millennials. I know as an investor, I can't time the market. So buckle up, drink some good Oleary Chardonnay, just selfless plug. It was my new Chard. And I did that every day at 4:01, and I just lived through that period with my team. And we accomplished that market return. Same thing about every other asset class we're talking about. You want to guess bonds? Buy a portfolio of fixed income with short duration under 5 years. Right now, on triple Bs, you can pick up 6, 7, 8% if you have fortitude. Bottom line is, because the policies there are uninvestable, you see all that capital moving into the US. Now, you can criticize the government in the United States, you can criticize democracy, you can criticize capitalism, but that's not what the market's doing. The index of that is the American dollar, the strongest currency on earth. And it remains that way for a singular reason. It's the safe bet for investors from all around the world. When we put capital to work for sovereign wealth, it all goes into the S&P. It doesn't go to Canada. It doesn't go to Mexico. It doesn't go to China. It doesn't go to Thailand. It goes into the S&P 500. It's the greatest economy on earth and the safest place of law and the best place to deploy capital. It has volatility, but until other countries can compete with what the US has, it's not going to change. And so it's a great model for all of the reasons to criticize it. The dollar says it all.
Yeah, the dollar has been absolutely incredible. But talking about volatility, I want to switch to something that's also been quite volatile, and that's been Elon Musk and his reputation. And we've got to now let sink in the fact that he is taking ownership of Twitter tomorrow at 5. And I'm curious your thoughts. There have been rumors on him potentially letting go 75% of the staff. Now he's come out saying, no, that's not true. The articles on that were wrong. Who knows? Maybe it was true. And then he changed his mind on it. Well, what's your take on an Elon-owned Twitter?
I think it's great. I wouldn't have paid what he paid for it. I would have thought there'd be a better price. I think that stock is worth $12 without Elon's bid. It's a poorly run company. It's a poorly managed company. No shareholders ever made any money on that till he came along. So once again, he's proven he can make money for shareholders if you were a Twitter shareholder. But prior to his bid, it was a rotating doors of managers that would just option themselves with millions of options, dilute the float, and cash themselves out. And 36 months later, they got whacked and a new manager came in. All of that wealth just went to the insiders in that company. The board was totally useless. They didn't even use the platform. Try and find a tweet from a board member. I mean, I hate to be critical, but these are facts. So if I were him, I would simply take a spatula and scrape that place clean and start from scratch, figure out a way to monetize it, maybe bring in a payment system. Who knows what he's going to do? But, you know, I think it's a good thing that's happened here. I would hope it becomes an open cry for all voices, because I'm a big believer in freedom of speech. And I think for all of the reasons that people try and criticize free speech, the best thing for free speech is more free speech and more transparency and more exposure and shining the light on bad ideas through discourse. And I think that's what he'll bring to Twitter. And I think that's a good thing. But as an investment, I'm glad I'm not an investor in it.
Got it. So now Elon and essentially his ownership here at Twitter has led to a big call about how corporate fairness and this idea that, hey, if you do go in and lay off individuals because you're trying to make the company more profitable, how is that fair to all of the thousands of employees who might be laid off? You know, this is unfair to employees. This idea that layoffs could happen because a new manager comes in. It sounds to me like perfect capitalism to run companies more efficiently, especially during a recession. It also seems like it's exactly what the Fed wants. But at what point do we balance out sort of those human rights?
I don't think this has anything to do with human rights. This has a lot to do with a very poorly managed company that needs an overhaul. And that is the basis of private equity and why it works. You should consider private equity, and I've been involved in this industry for almost 40 years. We are the sea slugs on the bottom of the ocean. When the protein dies and the big fish fall to the bottom, we repurpose that protein. We eat it up. We regenerate life out of it. We figure out how to make it useful again to the ocean. And that's exactly what's happening here. Twitter is a dead fish. It's dead. And now it has to be reconstituted through the private equity process, which means you scrape the patina off it, you carve out all the dead flesh. There's a horrific amount of waste in there. It's a terrible platform. I can't say enough bad things about it. And I think the market knew that already, and which is why he decided finally, you know, he's a creative thinker. You can't, I've made a lot of money with Elon Musk in his various opportunities as an investor. And I can't fault him for that. And I realize he'll probably make money with this too, if he's allowed to do what he can do, because no one else could. And it needed someone with a strong hand. It's a miserable place to work. In some ways, you're lucky to be, given a new chance on life to get out of there. I can't imagine many employees are happy working there. It's been a horrible place for the last 2 years.
Got it. Entrepreneurship. During recessions, great businesses can often be built. Is now an opportunity to actually launch a business, to launch a second business, a side hustle, to get licensed as a professional, whether it's a real estate agent or lender? Kevin, I think that your audio just got hit a little bit.
Really? How's that sound?
That it's buzzing for some reason now.
Oh, really?
It seems like right when you went for that cup, maybe.
Oh, let me see it. Any change?
That works. Okay, that's okay. That's good. So, what's your take? Entrepreneurship and launching businesses. Is now the time to do that?
It's always a good time to start a business. It's actually historically proven now that many businesses started in chaos and declines, and periods like 08, 09 ended up flourishing and becoming huge successes. I mean, desperation is mother's milk of necessity in terms of figuring out what to do next. And great entrepreneurs know how to pivot. I think what we learned about the pandemic and the companies that survived in my portfolio figured out a way to use technology, go direct to consumer right across the board, where margins were significantly better. And the data they're collecting now is significantly better than they used to get from retailers or just selling through Amazon. So I would argue that catastrophic outcome of a global pandemic made a lot of companies a lot stronger. And today we're having one of our best quarters ever and some of our best cash flows ever, because so much of our sales are now at full margin, direct to consumer, with information about their preferences. And so, I think entrepreneurship is never a destination. It's a journey. I encourage everybody that wants to do it. And if you look at graduating cohorts of engineers that I teach, I'm going to be doing this again in Massachusetts next week. I always go to the graduating cohort. A third of the class, men and women from all around the world, will start businesses. So about, 2/3 will be employees and 1/3 will be entrepreneurs. It's not an easy journey. I've always told people to get ready to sacrifice, because that's what's going to take. But ultimately, it does give you personal freedom if you're successful, not about the greed of money, but the ability to pursue the things that mean something to you, the freedom of choosing your own time and what to do with it.
Yeah, you're essentially your own boss. I mean, that's fantastic. You mentioned this idea that entrepreneurs need to be able to pivot. Sometimes, and there's a small group, but there's a small group of folks who think that I pivot too much. They call me a flip-flopper. And I'm not terribly offended by that idea, because I do change my mind a lot. I think that's almost necessary for not just entrepreneurship, but in some cases also investing. What's your take?
I agree with you. I actually think pivoting is part of the DNA of a successful entrepreneur, a successful manager, because the facts change all the time, and the facts are changing on an accelerated basis today. There's so many things occurring, just not only globally, but domestically, that you have to look every day at what is happening and to make decisions. And what I try and do is each day I leave the office or wherever I am with 3 mandates for the next day. 3 things I have to make a decision on. I don't even put them in a computer. I write them on a sticky note and stick them on the mirror. And I don't do anything until I get those 3 done the next day. It's very productive. And very often it's because of something that changed. Yesterday, rates were changing, and we were trying to manage some of our cash flows. And I sat down with my team and we looked globally at where to deploy some of this. And we made decisions that we would have never made 2 months ago, because rates are up. Liquidity is now starting to dry up a little bit in the credit markets, so we're trying to take advantage of that. These are all new pieces of information, and so great entrepreneurs absorb information, stay flexible. That's called pivoting. Take the new information and chart the path of least resistance, the path of least risk, and that's why they're leaders. People follow individuals that are able to do that because they trust their decision making. And when they don't trust it anymore is when you get a big collapse. And I'll show you an example of that happening as we speak. Look what's happening to Meta in Facebook. People are no longer believing in the big vision of the metaverse. In the case of Zuckerberg, and he's got a super voting control of that company. He may not care, but it's being reflected in the value of the overall company. Another 20% decline today.
Yeah, I think that's probably a whole 20 years too early. So we're out of time. I want to get, maybe if I could, just in sort of your outro line here, touch on really quick that 12th sector again, NFTs and crypto. Final thought on that we have to mention before we close out. Any closing thoughts you have? And then, of course, Kevin Oleary, thank you so much for being here.
Yeah, I would say I'm very excited about going into the new year around crypto, and I'll tell you why. Um, and I have to be transparent. You know, I'm an investor in Circle, which does USDC. I have many positions on, but they're one of them. And also an investor in FTX, both the US and the international company, and a paid spokesperson for FTX. So with those disclosures aside, if you're going to see something remarkable at Davos this year, which happens in mid-January. Each year that global gathering has a new theme. You know, a few years ago it was global warming, and then it became deglobalization, then globalization. This year you're going to see crypto at the top of the list of what is being discussed by global bankers, specifically around payment systems, where we talk about a ACH transfer between banks or SWIFT transfer internationally. These were private sector innovations decades ago that were heavily regulated by global governments. And for the first time now, products like stablecoins could really disrupt that at a significantly faster, more productive, more transparent, more auditable, but above all, far less expensive system for transferring global assets. And so you're going to see companies like Circle headline at that event, and I think it's going to be, Davos will be all, you're going to see a lot of crypto-based conversation at a global level with global governments as they struggle to find some kind of policy and regulation. And that bill, the Stablecoin Transparency Act, is at the forefront of that. That is a bipartisan US bill that I think could be marked up by the time we get to that place, because it'll be after the midterms on November 8th, which is going to be significant for crypto policy. I think what will happen in the House will help crypto policy. But I think all of this is going to be really fascinating, and why everybody should stay on their toes. Lots of